Welcome everyone to our 3-session course on Bill Williams Trading Indicators from Basics to Mastery. My name is Ali Mortazavi and I'm the head of education at Errante. In this course, we will delve into the unique insights in technical indicators developed by Mr. Bill Williams, aiming to enhance your trading strategies and market understanding. Let's get started in this exciting journey towards mastering these powerful tools. First, let me mention that this webinar is brought to you by Errante. We are an online broker committed to providing top-tier services and building lasting and trusting relationships with our clients and partners. Before we dive into today's content, please take a moment to read our general disclaimer. The information provided in this session is for educational purposes only and should not be considered as financial advice. Because trading involves significant risk and it's important to conduct your own research and seek professional guidance when necessary. Now let's move on the agenda for today. Okay, today we're going to embark on an exciting journey through the world of trading, especially focusing on Bill Williams trading system. Let's dive into what we will cover in this webinar. This method, crafted by the renowned trader Bill Williams, he is a robust trader, and we know this trading approach designed to help traders identify profitable opportunities into market. We will break down its core elements in 3 different sessions, and we will explore their application and to understand why it remains a trusted tool for many professional traders. Of course, then we have the insight into the psychology and philosophy of Mr. Bill Williams, let's say, market structure. Understanding the market isn't just about numbers and charts, it's also about psychology. In this segment, we will delve into the mindset of Bill Williams and his approach of trading. We will explore the psychological factors that drive market trends and how Williams' philosophy can help us make more informed decisions. This insight will be invaluable in mastering the emotional aspects of trading. Then, moving forward, we'll focus on market phases. Markets can be bullish, bearish, or in consolidation. Recognizing these phases is key to adjusting your trading strategies. We will go through various analysis methods to help you identify these phases accurately, ensuring you're always one step ahead in your trading game. Then we will talk about tools. Bill Williams has developed several trading tools that are designed to improve accuracy and efficiency. We will take a closer look at each of these tools, understand their functions, and let's say learn how to incorporate them into our trading practices. Mastering these tools will significantly enhance your trading performance. And finally, as always, we will open the floor for a Q&A session. This is your chance to ask questions, share your thoughts, and clarify any doubts you have. Interactive discussion will help you, reinforce your understanding and application of the Williams system. So thank you for your attention, and let's make this session as informative and engaging as possible. If you have any questions as we go along, feel free to ask. Just write it down through the chat box that you have in your platform. Okay, let's start by getting to know Mr. Bill Williams. With more than half a century of experience in trading and market analysis, Williams is a towering figure in trading world. His innovative approach blends technical analysis with trading psychology, providing traders with a comprehensive framework for understanding market dynamics. This combination has proven to be incredibly effective in navigating the complexities of the financial markets. Next, let's delve into Bill Williams' market views. He perceives financial markets as complex systems where human behavior plays a pivotal role. Williams emphasizes that to succeed in trading, one must understand the psychological factors that drive market participants. This perspective helps us appreciate that markets are not just about technical data, but also about the emotions and interactions of those involved. Recognizing these patterns can give traders a significant edge. And finally, let's talk about trading psychology. A crucial element of Williams' methodology is trading psychology. He teaches that cognitive biases and emotional responses can significantly impact our trading decisions. Williams underscored the importance of emotional control, advocating for strategies that help traders stay disciplined and focused. By mastering our emotions, we can avoid the pitfalls of impulsive decisions and instead make more calculated, rational choices. This psychological edge is what separates successful traders from the rest. Okay, we should know the Bill Williams rating system is built on a solid foundation that integrates technical indicators with psychological analysis. By merging these two elements, Williams created a system that not only helped in understanding market trends, but also in interpreting the psychological state of market participants. This holistic approach enhances decision making and improves trading outcomes. There are some main tools that Mr. Williams has developed. These tools are essential for analyzing market movements and making informed trading decisions. As you can see here on my slide, let us start with the first tool, the Accelerator or Decelerator Oscillator, which is designed to measure the momentum behind market movements. It helps us understand whether a trend is gaining or losing a strength, which is crucial for anticipating potential reversals. Then we have the uh, awesome oscillator. This tool is invaluable for identifying the dominant forces in the market, whether they're bullish or bearish. By analyzing this oscillator, we can spot trend changes early and adjust our strategies accordingly. And fractals, very well common and famous indicators or patterns that signify potential reversal points. They are essential for pointing key levels of support and resistances, which are critical for timing our trades effectively. And lastly, we have the Alligator indicator, which uses 3 moving averages to identify the direction and the strength of a trend. This visual representation helps us distinguish between trending and non-trending phases in the market, allowing for better strategic planning. And don't worry, we'll get through all the nuances about all of these tools in our next session. But today we are going to give you only the overview of the philosophy and let's say the point of view of Mr. Williams about this, which is essential to make the correct use of all of these tools. That's why we need to discuss this, the goal of this system. The primary goals of the Bill Williams rating system are twofold. First, it aims to accurately identify market trends and determine optimal entry and exit points. Second, it strives to provide a comprehensive framework for market analysis and trading. By achieving these goals, traders can enhance their strategic planning and execution, leading to more successful trading outcome. Now, let's delve into the philosophical and psychological principles that underpin Bill Williams' trading system. This approach is grounded in two main areas: trader market philosophy and trader psychology. Let's start with the market philosophy first. Bill Williams views markets as complex and uh, as a complex system. Understanding this complexity can help traders develop more effective strategies. And then markets are constantly changing and evolving, so traders must adapt to these dynamics to stay relevant and successful. Also, we need to understand the human interactions involved in the financial markets, because markets are driven by continuous interactions among traders, buying and selling forces. Recognizing these interactions can provide insights into market movements. However, it's really important to understand the unpredictable aspects of trading, or let's say market behaviors, because market behaviors are often unpredictable and influenced by various factors that we usually can't anticipate them. For example, you might have seen sometimes we see a very exaggerated reaction for a very minor flow or bad news in the market. So accepting this unpredictability is crucial for developing a flexible trading approach. That's why when you become a successful trader or market analyst, you're not going, you will not insist that you're always right. It doesn't matter. A successful trader is a trader who makes money from the market, not the one who is always right. Okay, because there are many unpredictable things that we need to understand that we can control them. So we need to have a very flexible approach to become a successful trader. That actually takes us to the second part of our discussion, which is a trader psychology. Because there are many things in the market that we can't anticipate and we can't, let's say, predict, so we need to focus on those areas that are under our control. So one of them we can name as fear and greed. These are the two primary emotions that can heavily influence trading decisions. Fear can lead to missed opportunities or premature exits, while greed can result in over trading or holding positions too long. And of course, emotional decision making is something that we need to understand before entering any trade. Many decisions in trading are influenced by emotions rather than logic. Recognizing this can help traders manage their reactions and make more rational choices. And then we have the understanding of emotions. It's crucial to know and understand one's emotions during trading. When we know that emotions are, let's say, the major drive of the of market price. So if we can understand our emotions, we can make a better decision. It's crucial to know and understand one's emotions during trading, because self-awareness can help in mitigating impulsive decisions driven by emotional responses, and also it will enable us to manage our stress and anxiety, because we know trading can be stressful, and the ability to manage psychological pressure is vital for maintaining clarity and focus. And we need to be aware of the impact of emotions. Emotions play a significant role in trading decisions. Being aware of this impact allows traders to develop strategies to, let's say, counteract emotional biases. So effective traders must learn to control their emotions in various situations to prevent emotional biases from affecting their trading strategies. And Williams' holistic approach integrates these principles to provide a comprehensive understanding of market dynamics and trader behavior. So by acknowledging the psychological factors and the complex nature of markets, traders can develop a more nuanced and effective trading strategy. That's why we need to learn Bill Williams' trading system. Now here in this segment, we will discuss the market structure in its various phases. Understanding these phases, of course, is very important because this is a way that we can interpret the tools that we will learn later in our next webinar. So let's start with the accumulation phase, where large investors, often referred to as smart money, begin to buy assets within a narrow price range. This phase typically occurs after a market decline when prices are relatively low and attractive. In the accumulation phase, savvy investors start buying currencies at lower prices, usually after a significant downturn. For instance, if the Euro-USD pair drops to a low point after a major economic announcement, large investors might see this as a buying opportunity. So during this phase, prices don't move much because these investors are quietly accumulating their positions. So trading volume is low, but the smart money is slowly building up their holdings. And that takes the market to the next level, which is markup phase, where prices begin to rise gradually. As we move into the markup phase, prices start to increase. Let's say, for example, the Euro-USD pair begins to rise due to positive economic data from the Eurozone somehow. And small investors start to notice this upward trend and join in, further driving up prices. Trading volume picks up as more and more traders enter the market, hoping to capitalize on the rising prices. And this phase continues as long as the market sentiment remains positive. And then we have a distribution phase, which is when large investors begin to sell their holdings. Prices reach their peak and trading volume is high as these investors offload their positions to smaller, less informed investors. So in in the distribution phase, the smart money starts selling. Imagine the Euro-USD pair has reached a high after a prolonged uptrend. Large investors decide it's time to take profits and start selling their positions. This selling pressure is absorbed by smaller investors who are still optimistic about further gains. The new, let's say, new joiners. And trading volume remains high, but the underlying strength starts to weaken as the big players exit the market. And following distribution is the decline phase, where prices fall rapidly. Small investors, realizing the market is turning, rush to sell, leading to panic and further price drops. During the decline phase, our prices drop quickly. Suppose negative news hits the market, causing, for example, the Euro-USD, previous example, to fall sharply, and small investors, seeing their positions go into the red, start selling in a panic. And this panic selling accelerates the price decline, and trading volume spikes as everyone rushes to exit their positions. This phase can be quite dramatic, with significant price drops in a short period. And then we have the stabilization phase as the final phase, where prices stabilize within a specific range and trading volume decreases as the market finds a balance between buyers and sellers. The stabilization phase comes after the market is absorbed the selling pressure, and prices start to move within a narrow range, reflecting a balance between buyers and sellers. For the Euro USD, per example, this might mean fluctuating within a tight range as the market waits for new information or events to drive the next move. Trading volume decreases, indicating that both buyers and sellers are hesitant to take significant positions until a clearer trend emerges. Understanding these phases helps traders identify where the market is and make more informed decisions. So this is the way that the price usually moves in the market. So in our next slides, we're going through these steps that help us to recognize, or let's say to identify, all of these phases on a price chart of each instrument to make a better trading decision. And here we are going to discuss how analyzing market structure helps us identify different phases of the market, which is the aim of Bill Williams trading system. This understanding is essential for making informed trading decisions and timing our trades effectively. First, let's talk about identifying market phases. Recognizing whether the market is in accumulation, a markup, distribution, or a decline is crucial. This analysis involves interpreting price behavior, spotting recurring patterns, and understanding changes in trading volume. In other words, identifying market phases is the foundation of successful trading. By analyzing and interpreting price behavior, we can spot patterns that indicate whether the market is in a phase of accumulation, markup, distribution, or decline. For example, recurring patterns like double tops or double bottoms can signal potential trend reversals. Understanding these phases allows us to time our entries and exits more effectively, and also we will be able to identify the correct market direction. Additionally, observing changes in trading volume can give us further confirmation of these phases. Next, let's delve into using technical indicators. Technical indicators are powerful allies in our analysis, for sure. The Alligator indicator, for example, one of the main tools of Bill Williams' trading system, for instance, uses moving averages to show whether the market is trending or not. Fractals, another tool, helps us identify reversal points by highlighting tops and bottoms in the market. By using these indicators, we can get a clearer picture of the current market phase. For example, if the Alligator shows a widening gap between its lines, it indicates a strong trend. So it can help us decide whether to enter or exit a trade. Combining these indicators with our analysis of price behavior strengthens our trading strategy, for sure. And then next, we have price behavior. Analyzing price behavior is another critical aspect. Price behavior tells us a lot about the market's current state. Patterns like head and shoulders, triangles, and flags can indicate the beginning or end of a phase. For instance, if we notice a head and shoulders pattern forming, it might suggest an upcoming reversal. Analyzing price fluctuations helps us understand the market's volatility and predict potential breakout points. Moreover, identifying support and resistance levels helps us set our entry and exit points more accurately, ensuring that we trade within safe parameters. And lastly, let's discuss the impact of trading volume on identifying market phases. We know in Forex trading, we don't have volume, actual volume that can show, let's say, the number of units traded, but for those who are interested or investing, let's say, somehow in the stock market, it's really crucial and essential factor to confirm all of the above because the trading volume is a key indicator of market sentiment. During the accumulation phase, we often see low volume as large investors quietly build their positions. As we move into the markup phase, volume increases as more traders enter the market. And high volume during the distribution phase indicates that large investors are selling off their holdings. Finally, decline phase often sees a spike in volume due to panic selling. By closely monitoring volume alongside price movements, we can confirm whether a price trend is genuine or likely to reverse. For example, a price increase on low volume might suggest a weak rally that could soon reverse. So it's a very useful indicator, again, in the stock trading. Now, here, we're going through the characteristic of each phase in forex market using charts to see how we can analyze and identify the market phase based on these characteristics that can help us to somehow predict the upcoming market movement, maybe more precisely. Okay? So let's start with the accumulation phase, a crucial period where large investors begin to accumulate positions. This phase typically occurs at the end of a downtrend or let's say an uptrend, because in forex you can trade both sides. And it signals the start of a new potential trend. So let's talk about the buy side market. Let's say talk about the buy signals. Okay, so at the start of an uptrend, where you can see that. So let me just maybe bring up my just a moment, please. Okay. I guess everyone can see my presentation, yes? Okay, great. Okay, great. Let's continue. For example, look at this part of the chart. Now we're going to recognize accumulation by large investors. First, the gradual increase in buying volume or in tick price. During the accumulation phase, we see gradual increase in buying volume by institutional investors. This is the first sign. Okay, so this can be identified by observing the volume histogram at the bottom of the chart showing increased activity, or looking at the price maybe coming up somehow. For example, here on my chart, you're able to see that after some market correction during a strong uptrend, as you see here, if I zoom out, you see the market has been a strong uptrend here, and then here you see a lot of range bound fluctuations in the market with the price ticking down and ticking up, which is a first sign of accumulation by large investors. And we can also look at the tick prices as a volume indicator in forex, and you see after this decline here during this phase, you see the tick prices are increasing somehow, pointing to increasing activities in the market. And then low and steady trading volumes. Despite the increase in buying, the overall trading volume remains relatively low and steady, as large investors prefer to build their positions quietly in the stock market. But in forex market, that we are using tick prices, and we know coming and going buyers and sellers can increase the number of tick prices, so we see the increase in volume. And then we should look for classic reversal patterns, such as double bottoms or inverted head and shoulders. These patterns indicate a potential shift from a downtrend to an uptrend. And then we need to look at pay attention to how prices react at significant support levels. If prices hold and rebound from these levels, it confirms the accumulation phase. By recognizing these signals, traders can position themselves early in the trend, capturing the initial upward movement. Next, we have the markup phase. Where the market experiences a strong uptrend. This phase follows the accumulation phase and is characterized by significant price increase. In the markup phase, prices start to rise steadily, indicating a strong uptrend. We use technical indicators like the Alligator and moving averages to confirm this upward momentum. For example, if the Alligator indicator shows its lines widening and pointing upwards, it suggests a strong uptrend. Or if you see the price breaks above the major moving averages, this is a potential sign of ongoing upward movement. So we use technical indicators. Or oscillators like the RSI and MACD, they can also indicate a strong upward momentum, providing us with buy signals. And this is a way to confirm that we are in a markup phase. As we see, for example, after forming this price pattern here, on the chart, if you look at the chart, we have the accumulating phase here, and also here at the end of the uptrend and at the end of the downtrend. See, the market is going range bound and then breaking above a significant resistance level, triggers a new phase in the market, which is a markup phase or markup phase. And also here you see the accumulation phase at the end of an uptrend, and then when the market the price just breaks below the a significant market support, we can confirm that a new phase in the market has begun. So it suggests a strong downtrend here or an uptrend here. Then we can use the other indicators to confirm it. For example, when you see the RSI is below 50, this is a signal of confirmation signal of the increasing or accelerating downward momentum. And also here, when we see during this breakout to the upside, we have the RSI above 50, so this is a signal to confirm this upward movement in the market, which is a transition from phase 1 to phase 2, from the accumulation to markup phase. So here you can identify patterns of higher high, the deformation of higher highs and higher lows, or higher tops and higher bottoms. These patterns is a key characteristics of the market phase, indicating the continuation of an upward price movement. During the market phase, one of the clear signs of an ongoing uptrend is the formation of higher tops and higher bottoms, as you can see here, for example. And during these downtrends, you should be able to identify the lower tops and lower bottoms clearly in distance, in a very clear and satisfying distance from each other. For example, here you see the major bottom and the top, and the lower bottom and lower top, and lower bottom and lower top, and this is a signature of a downtrend. And here, vice versa, we have the higher this bottom and the higher bottom and higher bottom here, and higher top and higher bottom, and this is a signature of a uptrend, of an uptrend in the market. So this pattern helps us identify potential entry points to buy, as the market is clearly in an upward trajectory or a downward movement. So identifying patterns of higher highs and higher lows on the price chart and indicating the continuation of an upward price movement are using in the oscillators like RSI and MACD are our weapons to enter the market to fight the let's say to enter into the market. And lastly, let's discuss the increase in trading volume during the market phase. As prices rise, trading volume typically increases, indicating greater market participation. And please note again, this is something for stock trading, not for forex trading, because in forex we don't have the actual volume, means the number of shares traded, but or the unit of currencies traded. We have the tick prices only, and the number of tick prices delivered to the server in a determined time. Okay, so the most important part here, which can give us a very, very clear and nice and clean entry point, is to understand the transition and confirming using other tools to enter the market. And then we have distribution phase. Sell signals at the start of a downtrend. During this phase, large investors, often referred to as institutional investors, begin to sell off their assets. And this usually happens after a significant uptrend with prices, when prices are high. During the distribution phase, a smart money starts to float their holdings at high prices. And this phase is marked by increasing sales by institutional investors. For example, if we observe the Euro USD pair reaching a peak after a prolonged uptrend, we might see a sudden increase in selling volume as well. And this indicates that large investors are exiting their positions. Identifying this phase gives us a sell signal, suggesting that it's a good time to consider exiting the market before the prices start to fall significantly. As the characteristics of this phase, it's worth to mention, let's say, increasing selling positions and formation of price patterns like double tops and head and shoulders somehow. So these patterns are crucial indicators that signal potential change in trend direction from up to down. And common patterns include double tops and head and shoulders, which often form at key resistance levels. Reversal patterns are at resistance levels, or powerful signals that an uptrend might be ending and a downtrend could be starting. For instance, if we observe a double top pattern formation, something like this double top pattern here, the end of the this uptrend, It suggests that the price is struggling to go higher and may soon reverse downwards. So similarly, head and shoulders pattern indicates a potential reversal as well. And these patterns combined with the reaction of prices to resistance levels like this strong rebound to the downside, uh, accompanied by the confirmation from the indicators or other oscillators like RSI or MACD, we can understand, or let's say we can realize the shift in the sentiment of the market. So that's another way. And in a stock trading, of course, you can accompany this with a high trading volume, which uh, reflected in increased trading volume during sell-off, and we can find signs of exiting long positions if we have any. And then we get to the decline phase. During this phase, the market experiences a downtrend, and we can identify this continuation using various technical indicators. In the decline phase, this is very similar to the accumulation phase in forex trading. Prices start to fall steadily, indicating a strong downtrend. For example, this is a decline phase, very similar to the accumulation phase of this uptrend to the down. Okay, so we use technical indicators like the Alligator and moving averages, or other tools like RSI and MACD that you see here to confirm the this accelerating downward momentum. For example, if the Alligator indicator shows its lines widening and pointing downwards with a negative slope, it suggests a strong downtrend. Similarly, moving averages crossing over each other and pointing downwards reinforce this trend. Oscillators like the RSI and MACD can also indicate a strong downward momentum, as you see here. At the beginning of this decline phase, we have the RSI crossing below 50. So the decline phase is usually sell signals for us, and we can identify using the indicators and confirm it with other oscillators and tools. And it's really important to notice the formation of lower highs and lower lows, or lower tops and bottoms. Identifying these patterns is really essential to make sure that the downtrend is going to continue. And for stock trading, we usually see it comes with increasing volume, and somehow we can realize the panic selling by retail investors as well. So that took us to the other, that takes us to the last, let's say, phase of the market, which is the stabilization phase, where the market shows no clear trend and fluctuates within a specific range. This phase often follows a period of high volatility and precedes a new trend. During this phase, the market doesn't show a clear trend and prices fluctuate within a stable range. As you, for example, see here, we can find the continuation patterns in the market, like flags, like rectangles, triangles, something like this. And this phase typically occurs after significant price movements and is characterized by short-term fluctuation without a clear direction. In the stabilization phase, prices move within a specific range without showing a clear trend. For example, if the Euro USD pair has been in a strong uptrend or downtrend, and then starts to move sideways within a defined range, it indicates a stabilization phase. For example, something like here, after this uptrend here and downtrend here and then uptrend here, and you see the market is going into a sideways movement. So it's not, it suggests that we have to avoid trading at this phase because the market is more unpredictable than before. So for example, here, if we look at the gold on let's say 1 hour chart, you see easily we can understand this accumulation phase here, and we see the tick prices increasing, and so we are a, and after let's say marking this market top, we can see a clear breakout above this key resistance here. So it means we have come into the new phase, which is a markup as here. And then we are going to see the higher tops and higher bottoms, maybe in a lower time frame would be more obvious for everyone. Yeah, like let's say something like this: the market top, market bottom, top, bottom, and market top and market bottom, something like this. Okay, and during this uptrend, which is a very sharp upward movement, we get to the point that we see the prices can't go higher above the last top, and this is the phase. This is another phase. So after this markup, we have the distribution of the other small investors in the market, and then we get to this point, and then we see the price is stabilizing before starting a new trend. So this is a phases of the market that we are going to use Bill Williams indicator in the next session to identify them, recognize them, and trade them. And this is a price stability within a specific range when we can't recognize or identify the market trend, market direction, because the market is not making or forming a higher tops and higher bottoms consistently. We see one higher top, one lower bottom, one lower top, one higher bottom, and this is something that we can't actually identify the market direction at the time. Okay, so thank you for attending today's session on Bill Williams trading indicators from basics to mastery. I hope you found the information valuable and insightful. Remember, mastering these tools and understanding market psychology can significantly enhance your trading strategies and outcomes. In our next session, we will dive deeper into each of Bill Williams indicators, exploring their applications and trading signals in greater detail. Stay tuned for more webinars, and don't hesitate to reach out if you have any questions or need further clarification on today's topics. Have a great day and happy trading.